Hello friends, welcome to Weekend Investing Daily Bytes. We're shooting episode 297. Today is 28th of October and we are revisiting the question, why momentum? A lot of you are momentum investors already, but a larger portion of people are still contemplating to add momentum to their strategies, and we'll revisit the base case why momentum should be your preferred style of investing. But first, let me get the offer out of the way. So, a very warm welcome to hundreds of new investors who have come in during this Diwali weekend, the last weekend, and many users have sent us messages that they've not been able to catch on to the offer in those 3 days. So, we've extended this offer for 2 more days, today and tomorrow. So this is valid till Saturday midnight, tomorrow night. So if you've not made use of the offer earlier, please go ahead and use the code EXT25 for this offer on all weekend investing small cases. So let's come back to the markets. So autos were predominantly the gainers in the day after Maruti results. Maruti stock hit an all-time new high. Energy stocks were going up. L&T doing very well in the infra space. Public sector enterprises reasonably in the green. The Nifty itself opened reasonably green, then went into the red, and then by the close it was marginally in the green at 0.3%. FMCG closed flat. The profit booking was seen in banking segments, so PSU banks and private banks, and of course IT is still reeling under the impact of Nasdaq, where big names like Facebook, like Amazon are biting the dust, dropping 20, 30, 40% in a few weeks, and we'll talk about this more later in this daily bite. And metals also taking off a bit along with pharma after a good run yesterday. So all in all, this last 1 week has seen a reasonably good run on PSU banks, good run on autos, good run on public sector enterprise, and some on metal. So reasonably, I would say we are well poised to go to an all-time high, but we are, let's say this is the calm before the storm, and my guess is that we go up very strongly. But who knows what happens. In terms of overall indices, broader indices, Nifty was the only index reasonably in the green, 0.28%. Nifty 200 also eked 0.07%. But other than that, all other broader indices, as you can see, were down about 0.5% on Nifty Next 50, 0.6% on small caps, and 0.64% on mid and small cap index. In the weekend investing strategies, all strategies were in the red except for MI Top 10, which gained 0.57%. Others were down between 0.25% to 1.3%. Mainly the losers, the larger losers were the small and mid cap ones, the segment which was falling. Heatmap for the day, as you can see, Maruti is up a very nice 5%. Reliance up a very nice 3%, Apollo Hospital up 3%, NTPC up 2%. These were all the gainers in the Nifty, all the good gainers in the Nifty, I would say. And the bigger losers were Sun Pharma, State Bank, ICICI Bank, Tata Steel, Grasim, Divi's Lab, Hindalco, and Tech Mahindra on the losing side. And then there were marginal winners and marginal losers, predominantly the upkick came due to Reliance and Maruti for the day. Infibeam Avenue up 20% at 17 rupees post guidance. Jubilant Pharma up 6%. Aegis Logistics up 6%. Sun Pharma Advanced Spark up 5%, Maruti Suzuki up also 5%. These were the top gainers. Balram Chini down 6.5% to 310. Nykaa has been cracking very, very hard. Nykaa is now down somewhere close to, I think, 60 odd percent from the top, and the lock-in period is yet to open. So November is full of opening of lock-in periods for the IPOs which came 6 months ago. So there will be a lot of sellers in many of these stocks, and we'll put up a list of lock-in candidates tomorrow in the next show. SBI Card also down 5.5%, Sumitomo down 5%, and Fine Organics also down 5%. So I think there is no tolerance for any disappointment in results at these levels. So as we have seen in Indian market as well as the US markets, the stocks are priced slightly on the higher side, and hence any disappointment is really a thrashing for that stock. PC Jewelers is a very strange case, and this we are talking about in context of the momentum plays. So you can see that for several years it did nothing and stayed around 10 to 20 rupees, and then from 20 rupees it has run up to 103 despite defaults and so on and so forth, and those were already known, and they've come out with the result where net profits have gone up dramatically and revenues are also up in a big way. But what the point to take away from here is that the market already knew about this. So the market started running somewhere in June from 20 rupees, and it had reached 103 before the public came to know about these results. The turnaround, or whatever you may call it, is there. So the adage, the BBC principle, the Bhav Bhagwan Che, has played out very well here, where the price has led the news in a extremely it has been front running the news in a sense that had you been playing momentum on this, you would have ridden the rally to this point before even you came to know about the turnaround. Again, another tenet of momentum, just like prices front run news on the upside, prices also front run news on the downside. So this is the case study of Web of Global, and we had this stock in many portfolios, but I think this example is there from MI50. So we entered this stock at 220 odd rupees in June 2020 after the COVID crash, after it started to go up, and then we exited it somewhere near 790 before this last peak came through. So we exited it in this down leg here, and fortunately did not catch this up leg in the next one, and it did a 72% fall before that. So question is that even if you did not catch the fastest moving bus, by avoiding those that crashed, you would still do better than most portfolios. So if you have a stock which has a nice run up and then a fall, and you capture a portion of this run up, you need not capture everything, because nobody can capture the bottom and nobody can capture the top. But if you can capture a significant portion of this run up and avoid this fall, the opportunity cost of your money can be deployed elsewhere. So not falling versus fast running, so if you want to have very rapid performance versus a case where you're not falling but you are having mediocre performance in terms of the upswing, it may be a better strategy, because if you are going up 100% and then falling 50% and then going up 100% then falling 50%, it may just be better to do 50-50 each time and not falling down. So again, the question of avoiding drawdowns, avoiding pain, avoiding these down moves will help you save on your overall returns as well as optimize the use of your capital. Another insight from momentum perspective is the Meta stock, which was earlier called Facebook. You can see that it had a dramatic run from $25 to $375 over the last 9 years, with a reasonably significant couple of corrections in 2018 and then the COVID correction in 2020. And predominantly, I would think that a large number of people would have come in post COVID here, when a large number of new users came to the market, huge number of new demat accounts in the US, also huge number of new participants, and a significant chunk of people got in here, and they are now down 75% from the top. So the question is, this is one of the world's most popular stock. It is being analyzed by the world's best analysts. You can name the analyst firm, investment bank, the index fund. You can name any analyst, and they are tracking this like the back of their hand. So thousands of brilliant minds have followed it, tracked it, researched it. However, the collective wisdom has failed. Nobody in the last 1 year was calling a 75% fall in this stock. At least I didn't hear about it. And commentators on television were egging up this stock at all stages. So after 75% down, if somebody says no, the earnings were high, or it was overpriced, earnings were not there, I mean, that's all hindsight, right? So if your system is able to get you out without this 75% loss, then it is worthwhile. Otherwise, you wasted 6 years of your investment life, and you have nothing to show. That's like getting stuck in a bus, which has no fuel in it. You're sitting in a very fancy bus, a Volvo air-conditioned bus, very luxurious seats, but it doesn't go anywhere. So what is the whole point of that? So you need to see your ride goes from A to B, and then if it starts to roll back, you need to get out. So I hope these are huge learnings, at least they are for me, and if you learn from these episodes, you can implement them in your own strategies, in your own investing, and really gain a lot out of all this. So those three sort of insights were examples of why you should practice momentum investing. It will give you a very structured way of getting in, getting out. So 4 questions get answered: what to buy, when to buy, how much to buy, and when to sell. These 4 questions, once you have answered in your strategy, nobody can beat you. Okay. So now coming to another insight about Indian numbers, and I may be right or wrong on this, but these are my thoughts, that most cars are not available off the shelf. I mean, that is quite a telling sign of heating up, and even demand going through the roof, and maybe some supplies also not being there, but robust demand for sure, despite increasing interest rates so far. 30% more gold sales on Dhanteras. People call it a pet rock, people call it a useless asset, but gold has given 11.x% CAGR over the last 50 years. It has saved portfolio holders in yen, in lira, in Venezuela, in so many other countries. If you were holding gold along with your equity, you got saved because your currency went for a smash, and that can happen anywhere. So if you are not a US dollar investor, so we are all mostly INR investors, so we need to protect ourselves. This is like insurance, this is like a hedge. Without this, you are swimming naked actually. Real estate has broken many records, especially I heard about NCR markets 2014 sales records have been broken this year. So we can see a lot of new development, lot of new developers, especially in Gurgaon, in Gurugram and Noida, so on and so forth. Many festive shopping mega sales offers from Amazon, Flipkart, etc. seems to be doing quite well. There is no dearth of shopping demand, so as to say. And the Nifty itself is telling you the biggest story. You should allow the charts to speak back to you. Of course, it will not be 100%. There will be, times when you'll hit a false alarm. But then more likely than not, the chart will tell you a true story. And the chart is currently telling you a story that India is about to go up. India is sitting at a 52-week high when most other markets are sitting at 52-week lows. What is it telling you? It is not some, magic that is happening, that we are at 52-week highs versus others are at 52 low. It is the strength of the economy. It is what the market is perceiving the next 12 months to be like. That's why we are sitting at 52-week highs. So, do you need to be afraid at 52-week highs? No. As long as you have a strategy in place that can take you out of your stocks in case things go wrong, you have nothing to worry about. In fact, 52-week high means that there is a very high probability that we will keep going up. The probability of a stock or an index going higher is much high near the 52-week highs than at any other place. You can go and calculate. So that's what the whole concept of momentum is. So need not be afraid about the markets. And once again, a very warm welcome to all of those who have joined us. And for those who missed out, please use the code EXT25 till October 29 to subscribe to any of our strategies. And my request to anybody who's listening to this is, if you like the content, please do share it with at least one friend of yours. One friend, one relative, your family, your kid, your parents, your brothers, your sisters. If you will help somebody in their knowledge by even 1%, it will compound for them, for their family, for their families' next generations for a long time. This exposure towards equity is still very, very low. People still don't have confidence in the equity markets the way they should have. So your contribution to the rest of the society, with you being a reasonably experienced investor, is to share good content with them. And if you like this, please do share it. That will be my sort of thank you to you for doing this for me. So thank you for my time. If you have any questions, do let us know at support@weekendinvesting.com, and have a great weekend. Bye.